In July, Tesla registrations rose 86% in France and 52% in Denmark. During the exact same month, they fell 97% in Norway, 81% in Spain, 77% in Italy, 69% in Portugal, and 60% in Sweden.
When you examine that data side by side, I mean, the initial impression is that each of these countries must be buying from a completely different manufacturer. But we are looking at the exact same company, operating within a single European economic bloc, attempting to sell a similar lineup of vehicles.
That stark disparity in the data is exactly why we are opening this analysis today. We need to establish a central thesis for you. The decisive price of a vehicle is no longer the number displayed on the online configurator. The true price is, well, it's the final monthly payment that remains only after government subsidies, manufacturer discounts, finance company terms, and tax authority interventions have entirely altered the transaction.
Taking that approach clarifies that we are not observing a traditional brand recovery. If this were a durable structural brand recovery, it would appear across multiple markets with, a reliable degree of consistency. Despite battery electric vehicles capturing 20.7% of new EU registrations in the first half of the year, which is up from 15.6% a year earlier, the European market is severely fragmented.
Right. What the data actually reveals is a manufacturer attempting to navigate disparate tax systems, closing incentive windows, highly specific finance channels, and rigid delivery calendars.
To understand how those regulatory interventions directly impact consumer behavior, let's just meticulously break down the mathematics of that final payment. If you put yourself in the position of a household evaluating their budget, we can examine a standard €45,000 electric vehicle.
If a state government provides a, say, €4,000 purchase incentive, it reduces the initial financed amount down to €41,000. And that is before we even factor in personal deposits, trade-in equities, interest rates, and origination fees.
When you spread that €4,000 capital reduction across a standard 48-month lease term, it lowers the monthly payment for that household by approximately €83 before the compounding effects of financing.
From a macro-analytical perspective, we have to evaluate whether an €80 swing is actually material to the broader market. And the data indicates that it is entirely sufficient to lose a household to a hybrid alternative.
It fundamentally alters the decision matrix. The consumer base currently transitioning to electric vehicles exhibits extreme price sensitivity. If you are a buyer sitting at your kitchen table trying to figure out if you can afford to make the transition to electric, you are evaluating strict limits on monthly outflows.
That €80 differential is often the exact threshold between completing the EV transaction or defaulting to a lower-cost internal combustion or hybrid model, which means national policy is no longer just a regulatory backdrop. Policy acts as a direct conversion channel.
And the approaches to that policy vary wildly. Consider the structural contrast between Germany and France. Germany has deployed a very broad subsidy approach. Eligible private households receive between €3,000 and €6,000, backed by a robust €3 billion budget.
That capital is specifically intended to target 800,000 vehicles through 2029. It operates as a broad, market-wide affordability bridge. France, conversely, approached their recent intervention with an entirely different philosophy.
Right. They structured a highly targeted social leasing program. The state imposed stringent income thresholds on the applicants, specific commuting distance requirements, strict vehicle price caps, and rigorous environmental criteria.
This is not a general rebate where the capital flows freely. The French state dictates the eligible household, the eligible vehicle, and strictly controls the maximum monthly payment.
So if we trace the operational reality for an automaker managing these varied policies, it forms a rigid transmission chain. A regulatory change in the state subsidy immediately changes the monthly payment calculated for the consumer.
That modified payment dictates the order conversion rate on the manufacturer's website. The resulting conversion rate determines exactly where the manufacturer must allocate its existing inventory.
That inventory allocation ultimately becomes the regional registration data we see. And finally, those localized registrations dictate the scheduling and output on the factory floor. Brand loyalty certainly wins consumer attention at the top of the funnel, but it does not repeal the constraints of a household budget.
You can have the highest brand equity in the sector, but if the final monthly payment fails the household budget test because a regional incentive expired, well, that attention will not convert into a delivery. Now, if we look at the positive side of the operational data, there are definitive indicators supporting Tesla's volume.
The Model Y refresh has updated their highest volume European product. They continue to maintain a highly competitive proprietary charging network. And they reported strong second quarter global deliveries reaching 480,126 vehicles.
We have to dissect the volatility within that volume before we assess its durability, though. The top-line delivery number is strong, but the regional volatility tells a more complex story. Take that 77% registration drop in Italy during July that I mentioned at the open.
A 77% drop in a single month looks catastrophic on paper. But if you look at the wider timeline, you have to ask how much of that is genuine demand destruction. Tesla's Italian registrations for the first 7 months of the year were actually up almost 16%.
That discrepancy highlights the noise in the numbers. The July collapse in Italy is primarily a function of international delivery batching at the start of a new quarter.
The manufacturer prioritizes moving large volumes of vehicles to specific regions based on logistics schedules. When local stock runs dry between those massive shipments, it produces a sharp statistical drop. That 77% decline is a supply chain artifact, not an indicator of a total collapse in underlying Italian demand.
We can observe another severe policy distortion in Norway, which requires careful analysis. The Norwegian government is actively compressing its value-added tax exemption for electric cars. The exemption threshold shrinks from 500,000 Norwegian kroner down to 300,000 kroner in 2026.
And after that, the remaining benefit is scheduled to disappear entirely in 2027. That specific regulatory schedule created a massive pull forward in consumer demand. Buyers rationally executed their vehicle purchases ahead of the looming tax changes to secure the lower price.
Therefore, the subsequent 97% decline in Norway operates like a hangover. It is essentially a demand vacuum. All the purchasing power that would have normally been spread across the summer was accelerated into the spring.
That drop is a direct artifact of taxation and timing, rather than a pure referendum on Tesla's product appeal. Managing that kind of extreme month-to-month volatility highlights a structural exposure within Tesla's direct sales model.
From an engineering and logistics standpoint, the direct sales approach provides tremendous agility. The manufacturer can alter a lease offer on their website or redirect vehicle shipments between European countries almost immediately. They bypass the rigid bureaucracy of a traditional franchise dealer network.
The skeptical financial counterpoint to that agility is that the direct sales model removes a critical financial buffer. In a traditional system, an independent dealer network acts as a shock absorber for inventory.
The manufacturer sells the cars to the dealers, recognizes the revenue, and the independent dealers carry the working capital risk on their own lots.
Without that network, all of the demand forecasting risk and the entirety of the working capital burden sits directly on Tesla's balance sheet. When European demand fluctuates wildly based on an Italian delivery batch or a Norwegian tax deadline, Tesla carries the physical inventory and the financial weight of those unsold vehicles.
And holding that inventory brings us directly to the capital expenditure realities of Gigafactory Berlin Brandenburg. A manufacturing plant of that scale carries immense fixed costs, regardless of its daily output. We are looking at massive facility depreciation, fixed salaried labor, specialized tooling, ongoing maintenance, and heavy utilities.
If the production output slows down because vehicles are sitting in inventory, the fixed cost carried by every single vehicle that does roll off the line automatically increases. That operational leverage creates a direct link between a French leasing subsidy and German manufacturing economics.
If public policy weakens across Europe and consumer demand slows, executive management faces a tightening set of choices to protect that plant's utilization rate. They can choose to cut production, which raises per-vehicle costs.
Or they can choose to carry the excess inventory, which ties up working capital. They can subsidize lower interest rates. Or they can directly cut the sticker price. But every single one of those options transfers the financial cost somewhere onto Tesla's balance sheet.
And choosing to implement direct price cuts introduces the residual value trap. Consider the residual value structure as a financial ticking clock for an automaker. Let's walk through the specific mechanics.
If a customer leases a €45,000 vehicle, they are not purchasing the entire asset. They are financing the expected depreciation. If that vehicle has an expected end-of-lease residual value of €25,000 in 3 years, the lease payments are structured to finance the €20,000 of depreciation that occurs in the interim.
But if the manufacturer institutes aggressive price cuts on brand new cars to clear their current inventory, well, the used market reprices immediately.
If that expected residual value of the leased vehicle is suddenly pushed down from €25,000 to €22,000, it instantly creates a €3,000 depreciation burden that was not modeled in the original contract. That €3,000 gap must be financed, or it must be absorbed as a direct loss.
which illustrates a severe structural conflict for management. Clearing excess inventory today through direct price cuts actively destroys the residual values of tomorrow.
The next customer's lease payment will inevitably increase to account for that faster depreciation unless the manufacturer, the third-party lessor, or government steps in to absorb that €3,000 difference.
This is the critical inflection point of the entire European EV market. It explains why public support and manufacturer support are entirely different economic mechanisms, even if they look identical to the consumer.
A €4,000 government grant lowers the payment for the buyer, but crucially, it preserves Tesla's realized price and protects the underlying asset value. A €4,000 manufacturer discount achieves the exact same monthly payment for the buyer, but it eats directly into Tesla's revenue and permanently damages those future residual values.
The recent margin data grounds the severity of this risk. In the second quarter, Tesla's automotive gross margin dropped to 16.9%, which is down from 17.2% year over year. Concurrently, their research and development expenses surged 49% to $2.371 billion.
That 49% surge in R&D is funding massive external capital expenditures. The company is heavily investing in artificial intelligence, advanced robotics, and autonomous driving networks.
For those investments to continue without requiring dilutive external capital, the core automotive operation must remain a highly efficient cash generator. Margin compression in the European theater directly threatens the capital flow required to sustain that external capex burden.
To understand how they manage that margin pressure, we have to analyze the geoeconomic stack. It is vital to frame Europe not as a single, unified EV market, but as a complex stack of distinct national rulebooks. The regulatory environment shifts at every border.
The United Kingdom utilizes strict zero-emission mandates, essentially forcing manufacturer compliance through quotas. Conversely, Italy and Spain rely heavily on budget-limited scrappage programs to incentivize older vehicles off the road.
Then you have France, which has introduced a comprehensive environmental score. This metric goes far beyond tailpipe emissions. It factors in the carbon footprint of the vehicle's manufacturing location, the maritime and rail transport logistics required to deliver it, and the specific energy grid mix used during its production.
Simultaneously, the European Union has applied a 7.8% countervailing duty on Tesla EVs produced in Shanghai, which is applied on top of the standard import tariffs.
This operates like a multidimensional chessboard for Tesla's logistics and finance teams, creating a highly complex allocation problem. They must mathematically calculate which factory, Berlin or Shanghai, supplies the specific vehicle.
They must match that factory's output to the European market, exhibiting the strongest post-policy consumer demand. And they must carefully weigh the cost of those EU tariffs against the potential margin erosion of running Berlin below capacity.
The nature of automotive competition has moved far beyond simple product versus product comparisons. The new reality dictating market share is the product, plus the factory origin, plus the internal financing structure, plus the specific national policy of the destination country.
Based on these interconnected variables, we can model two primary scenarios for the European market over the next 12 to 24 months. Scenario 1 is the self-sustaining demand model.
In this bullish case, the government's share of the monthly payment declines smoothly over time. Concurrent with that decline, battery costs and manufacturing efficiencies improve enough to completely offset the withdrawn subsidies.
Under this scenario, Gigafactory Berlin utilization rises steadily, inventory turns over efficiently, and used EV values stabilize without requiring massive, margin-crushing manufacturer discounts to clear the lots.
Scenario 2 is the policy dependence model. In this bearish case, European governments pull back their support abruptly due to acute fiscal pressure and budget deficits.
Simultaneously, competitors flood the European market with aggressive plug-in hybrids and lower-cost battery electric models.
To protect Berlin's utilization rates and prevent fixed costs from spiraling, Tesla is forced to fund the affordability gap themselves, utilizing aggressive finance support and direct price cuts that severely compress their automotive gross margins.
To track which of these two scenarios is actually materializing on a quarterly basis, we must look entirely past the total registration volume. The definitive metric for analyzing this market transition is the recovery quality ratio.
We define the recovery quality ratio strictly as the amount of private, manufacturer-funded discount required to close a sale, measured only after public support has already lowered the monthly payment.
If that specific ratio remains low, The volume recovery is durable and financially sound.
If that ratio climbs high, the volume represents expensive, low-quality growth that degrades the balance sheet.
To summarize the strategic board immediately following that definition, the clear winners in this fragmented, heavily subsidized environment are the consumers, who benefit directly from targeted state policies and intense manufacturer price competition.
Major leasing companies and national governments also gain significant leverage over automotive pricing structures and the location of manufacturing capital.
The highly exposed players are the automakers carrying massive fixed production costs, expensive internal finance structures, and limited supply chain agility. Tesla's specific quantified risk in this European market is that their sheer volume of registrations may recover significantly faster than their localized pricing power.
Subscribe to the Unlayered Global if you value analysis that follows the car from public policy to the household payment and then back into the manufacturer's margin.
Tell us which factor will matter most for Tesla in Europe: lower vehicle prices, more stable incentives, or a broader product range.